My name's Ethan Braid. Today we're going to take a look at what happens when you spend 5% of your retirement portfolio and adjust that spending for inflation. Then we're going to take a look at a couple of spending strategies that I think are more reliable than spending 5%. Before we get into the spending strategies, let me give you a quick overview of the mutual fund that we're using for these illustrations. We're looking at the Vanguard Balanced Index Fund. This is a very popular retirement investment. This fund is classified as a moderate allocation mutual fund, has a very low expense ratio of 0.18%. The fund has a dividend yield over the last 12 months of 1.9%. The fund is very diversified with 15,725 holdings. The fund has an asset allocation that is about 60% in the stock market and then the other 40% in bonds and cash. The fund has a tilt towards large cap growth stocks with 37.6% in large cap growth. You'll see that there are mid cap stocks and small cap stocks. Also, the fund is predominantly invested in the Americas with only a very small amount in international. And the fund has holdings that everyone will recognize. The top holdings of the fund are Apple, Microsoft, Amazon, Nvidia, Google, etc. When you spend 5% of your portfolio and you adjust your spending for inflation, you are running a risk that you could run out of money during your retirement. What I have in front of us is an illustration for $1 million investment in a very popular retirement fund, the Vanguard Balanced Index Fund. And we're taking 5% in the first year, $50,000, and then we're adjusting that distribution every year by 3%. And what you see is that we would have run out of money after 23 years if we use this spending strategy. A close look at the numbers shows us how we get in trouble with spending 5% of a retirement portfolio. Here's our $1 million investment. We're using the year 2000 as our starting point. We take out $50,000 in the first year. We grow that distribution by 3% every year for inflation. And then here's what causes the problem. This total reinvest column is the amount of money that the fund is actually earning. This would be dividends from stocks, T-bill interest, coupons from bonds, etc. And notice there's a big discrepancy between these two columns. We're spending more than we're earning, and that's a real problem. And then when you have losses like we did here in 2000, 2001, 2002, it really compounds the problem. That's why we go from $1 million to 700 and some thousand in just a couple short years, because we're spending more than the fund is earning, and we had some market losses. And where that ultimately gets us is we run out of money here in the year 2022. This is our last distribution here in 2022. If you've seen other videos that I've made on this topic, then you know that there are some funds that have sustained a 5% spending rate, inflation adjusted, since the year 2000. However, I would caution investors to be careful with a 5% inflation adjusted spending rate because it can put a lot of stress on a portfolio. Now let's take a look at some alternative spending strategies using this Vanguard Balanced Index Fund. Here's a look at 4% spending, inflation adjusted, over the last 25 years. Many people call this the 4% rule. We're starting in the year 2000, we're spending $40,000 in the first year, and we're adjusting that by 3% for inflation every single year throughout this illustration, and everything else the same, starting with $1 million investment, Vanguard Balanced Index Fund. And what happens is our portfolio declines over time, but we don't run out of money. So if you're planning on a 25 or 30-year retirement, this may be a spending strategy that could work for you. A note of caution, however, if you have any large unplanned distributions throughout this sequence, especially if your timing is bad, like here in 2008, 2009, it can really mess things up. I still think this is a heavy withdrawal on a portfolio, but nonetheless, this strategy has held up with this Vanguard Balanced Index Fund over the last 25 years. The 4% rule gets a lot of attention, and rightly so. It tends to work. I think your biggest issues, however, with the 4% rule are any large unplanned distributions and market losses. A great way to improve the 4% rule, in my opinion, is to the extent possible, if you are in a down market and you recognize that, back off on your distribution. If you can reduce your distribution when you're in a bear market or a recession, it will go a long way to protect your principal and increase the longevity for your retirement portfolio. Here's a quick look at the numbers for 4% spending strategy, also known as the 4% rule. $1 million investment here in the year 2000. We take out $40,000 in the first year, then we grow that by 3% for inflation. And we finish up after 25 distributions, 25 years, with $655,000 at the end of January in 2024. Now let's take a look at a spending strategy that I think is bulletproof and gives you some flexibility with respect to market losses as well as fund selection. In other words, you've got some ability to make some mistakes and you'll still be okay in the long run. This illustration is for 3% inflation-adjusted spending over the last 25 years. And what a difference just moving from 4% to 3% makes in your long-term portfolio results. We're starting in the year 2000 with our $1 million investment in the Vanguard Balanced Index Fund, and we end up after 25 years with $1.5 million. The nice thing about spending 3% is that your distribution is much closer to the actual income of the fund. Notice that what we're taking out of the fund is a lot closer to what the fund is earning, and what that means is we're relying a lot less on capital gains and a lot more on actual income of the fund. And this is the big difference between spending 3% and spending, say, 5% or 4%. When you spend 5% of your portfolio, like we did in the first illustration, you're much more reliant upon capital gains. But capital gains are not something that can be relied upon for retirement income. After 25 annual retirement distributions, our final distribution is $60,984. And our portfolio value finishes at $1.541 million. I like to use these historical illustrations because they give us actual data and give us a strong sense for what really happened. Here's something else to think about if you're getting close to retirement. If you're retirement age today, that means that in 2008, at the last great recession and big market drop, you were in your late 40s. Since that time, you've probably accumulated a lot more wealth, and your mindset now is going to be different than it was back then. So one thing I want to make people aware of is that when you get into retirement, you're not earning money anymore, and you don't have the time to make up market losses. So it's something you really want to think about, both with your financial planning software tools, forecasting, etc., but also going forward, your spending strategy. How are you going to react if we do get a big market drop? The average retiree is going to have at least one significant bear market during their retirement. Bear markets average about 17 plus years, and we've had 3 in the last century. We're probably going to have one here again in the future, and it might not be too far off. So when you select your spending strategy, you want to bear in mind that there will be volatility in the markets, and you're not in your 30s or 40s if you're retired now or getting ready to retire. And how you react to market volatility is going to have a big influence on the success of your retirement plan in conjunction with your spending rule. That's why I'm a big fan of a 3% spending rule, using 3%, adjusting that for inflation, because it gives you some margin for error. And it allows you to compensate for all the unexpected things that can happen in the course of a retirement. Stuff to think about. I hope this video was helpful. I hope this video got you thinking, helps you better analyze your investments, and overall improve your family's financial plan.